Today is September 13th, 2015. It is 10:18 a.m. New York time, Eastern Standard Time. This is Clueless 8 Advanced Coaching Session. Full disclosure, this is purely for financial education and not for solicitation or advice. Let's kick off our session this morning, and thank you for attending. I need to do a quick roll call. I have Mark Bader. I have Gone Tomorrow. Yep. I have Jackie. I have KJS. I have Stork Nandu. I have Nia. I have Tom Halsell, Fairway Trader, in attendance today. Couple of quick, let me get this out and minimize it. Great. I'm a couple of quick administrative things here. Number one, very important. Given what we're going through and given what we will be going through going forward, no question in my mind, it is almost imperative that all of you at all times, whenever you can, and I know there's people who can't be actively looking at the markets and checking everything on a minute by minute basis, but it is imperative that at some point during the day, even if it's later in the day, you have to review every single one of my posts and at least spend a couple of minutes looking over the charts. It is becoming critically important in this intensely volatile, and it sounds like a cliche these days, intensely volatile environment that you track, adapt, and understand exactly what that piece by Dr. Steenberger talked about. And that gentleman has coached traders who are billion-dollar traders. Okay, and that you learn how to adapt. Adaptation and flexibility is not something that's learned in one day. It is not something I can teach. My first interview on Wall Street, from on one of the bigger firms, my first boss at that time told me, "I can teach you everything, Frank. I can't teach you personality, and I like what you have, and you're hired." So that was one of the biggest days of my life. So I can teach you guys your mannerisms, your personality, your attitude towards life, your attitude towards trading, because they are all meshed in together. So that's something you develop on your own. But I will certainly strive my best to provide every single tool that's out there, or I shouldn't say every single tool, whatever in my human capacity that I can provide, and then you guys adapt and run with it. Extremely critical. There's no question about it. So the Twitter feeds are very important. The end of the day video casts, content that I've been producing more often. These are very relevant to what's going on, and also very importantly, the Periscope feeds that I believe stay alive for about 24 to 48 hours, from what I understand, and then they're no longer available, need to be clicked on and quickly looked at. I do those Periscope video casts simply because I want to show in real time a lot of the stuff that I'm showing on static charts, on these type of charts, and how they're developing. So it's really as simple as that. Okay, so the third and most important point is, and this is really critical, is the information laid out on the chat rooms, the information laid out on the Twitter feed is pretty clear and delivered in a straightforward manner. I've had a couple of instances, there's nothing wrong with that, I guess, where people keep on repeatedly asking me the same question. Now, I have no problem responding. Part of my service, a good portion of my service, which I believe is extremely effective, is I'm interacting with people in some cases on a hourly, if not a minute by minute basis. But you have to have the simple things like scrolling back, reading the stuff that's been talked about before, and having a relevancy in the string of conversations that's taking place in the chat room. The chat room is not there. The chat room is there to just exchange basic conversational ideas. It is not the pipeline that I deliver the information. This is very important for people like Nandu who have joined the service, and I'm going to address this for a lot of the newer people. Older ones obviously know very well how the game works, but you gotta basically do your homework on your side. I'm not talking to one person, just in general, so that just so that when you're in when you're in class, you know what's being talked about. Really as simple as that. So preparation is key. Doesn't have mean that you have to sit there for 3 hours at the end of the day going over everything, but spend 15, 20 minutes. I used to look at services where the guy just put up charts. Most of the services do. End of the day, I got an email, looked at the charts, little explanations on that stuff. No interaction, nothing. It was up to me to look at it and over time develop a sense of what's going on. Well, I go far, far beyond that. So the point is that it is very important that you guys become self-sufficient and independent, because the key mission, and it's very important that I say this, the key mission of my service is that this is a the Clear Estate service is really designed for to inform and educate investors and traders with and on a real-time basis on trades and everything else. So that's fine, but also give them a broader focus on a view of the markets, period. So I just want people to really remind themselves on that, because I've had a couple of instances over the past couple of days in the middle of markets which are completely insane, structured insanity, call it structured volatility, just going over and asking the same things over and over again, and at the same time asking me to predict what's going to happen over the next 20 minutes when machines are changing patterns within 15 seconds. Nothing wrong with them asking that, but just be prepared that there is no linear. It's not 1 + 1 = 2. You've heard me say this 100 times and I keep on saying it. It is not 1 + 1 = 2. Now, saying all that, when you look at the bigger picture, as we're doing now and we will do today, you're going to see that there is a pattern developing. The pattern won't be a straightforward pattern where you put a trade in at 9 in the morning and you come back at 2 and say, hey, whoopee, I'm taking the trade. Well, it happens quite often, believe me. But then at the same time, most often than not, in this type of environment we're going through, especially coming next week, it is not going to happen. So if you're expecting easy stuff, well, please prepare yourself for difficulty. If we're going to prepare ourselves for difficulty today, so that next week is going to be relatively easy, period. Because I am always on my toes, but I am never terrified. What's there to be terrified about? You have a couple of bucks in the market, and God forbid something really terrible happens, you lose some money. Okay, you lose money, great. Is that the end of the world? No. Because you come back right away the same day, or you come back the next day, and you can make that money and a lot more back. So if you sit there crying in your soup like, oh my God, I lost some money, I can guarantee you, that's the only guarantee I can give you in life, is that you are going to lose more money, because your confidence is so shot that you won't even know. Even if you get into, like it happens all the time, you get into the right trade and you mismanage it thoroughly, because the little demons in your head, that little voice that keeps on telling you, oh my God, I'm going to slip, I'm going to slip. Well, why don't you think about it this way? Oh my God, I'm going to take another step forward, moving forward. No, that little demon that tells you, I'm going to slip, market goes boom, sell program comes in, our market's down 50 points. Guess what? Your trade's gone, you're done. Next day, same story. So ask yourself the question, how many times are you going to keep on doing that? Don't blame the market, please. I'm done blaming the market. This is the reality of what's going on, and this is what we have to go through. Please stop blaming the market. Like I tell my kids, stop blaming the world. And he's a good kid, so he stopped. He doesn't actually, compared to other teenagers, he's great. Meaning that, stop blaming everything else. Oh, my teacher was like this. Oh, they gave you too much. Who cares? Deal with what you have in your hand. That's trading. So people like Nandu and people like a couple of other people who are new, please realize that this is hard stuff, but guess what? It's great money. And we showed that repeatedly, day after day, and some days we have bad days. So, bad days meaning like, the trade doesn't work or whatever. So what? Then you have days like Friday where markets open down, fool everybody for most part of the day, and then go. I walk people through that every single step. So get with it. That's basically what I'm getting. Read this guy, Larry Winget, okay? Don't make your own life's soap opera and your own drama play out as a soap opera that you're living by. Just get with it, okay? Serious, because I tell that to myself all the time. Okay, so let's get straight. So that's sort of the mental part of it, and it's the most critical part. So that we're going to break down this session in three parts. We did the administrative part. We talked a little bit about keeping your mental sanity and moving forward. Now we're going to dive into some pure technicals. And actually, before the technicals, let me give you some fundamental backdrop. We have a very critical week coming. Okay, and it's going to feel like it's going to be the make or break, all or nothing. Like, oh my God, if this week doesn't work out, we are finished. Garbage. The Fed is going to raise rates or not raise rates. We don't know yet. There are two camps on Wall Street, big time. Okay, both powerful camps. One wants them to raise rates. I'm in the camp I want them to raise rates. Raise rates a quarter of a percentage point. Get this constipation out. And the other camp says, no, don't raise rates because the rest of the world does really, they're going to need they're going to need a year's supply of diapers because if you do that, well, let the rest of the world wake up. Let them manage their currencies. Let them manage their economies. We cannot be held hostage to emerging market problems just because they are scared stiff about what a minute, inconsequential rate rise, quarter of a percentage point by the US Federal Reserve will do. We have to look at our own house. Time to really start looking at our own economy and doing things what are good for us. Let them handle it. Let them figure it out. Because I'll remind you guys one thing. If you remember a year ago, and before I go any further, can everyone hear me loud and clear?
Yes.
Yes, everyone hear me? Can I have a yes from everyone?
Yes.
Yeah.
Okay, because this is critical. All right. So the bottom line is, if you remember a year ago, emerging markets were up 30%, 40%, 50%, 60%. Philippines, Thailand, even China. Huge. Even China is up 22 some percent for the year, despite their pullback. And we were just like flailing around, like, oh, are we gonna? Well, guess what? Every action has equal reaction. Emerging market money flows from the U.S., and I'll explain that in a quick second. And it went in there, and their own money, gambling right, left, and center. No offense meant to anybody who's from China. I remind everyone, my son was in China last year. He had a phenomenal time. It was just, look, it's got nothing to do with the countries. How about that? Okay, here is what it is, and I'm going to say it straight out. You gamble hard, you lose. In 1 month, when you open almost 200 million accounts, you can't even read the stock quotes, and the market is going up like gangbusters. There are billboards on the highways saying that buy stocks because it's great for the country. Well, what do you think is going to happen? Well, that's exactly what happened. And then the Chinese government and the PBOC came in and tried to do all kinds of stuff. Didn't work. The Chinese market is in the process of stabilization right now. That's how you grow up. Like Gary Bussey, who is one of the Wall Street Journal great financial writers, said the other day, that there should be a sign in front of the Shanghai Stock Exchange saying "infants at play," or he said something like that. Okay, so that shook up the whole thing, and that had ripple effects. Then the Chinese devaluation, which was a correct thing that they did, by the way, for the longer term, had short-term repercussions. Other countries around there in Southeast Asia, powerful economies like Malaysia, Thailand, and Korea, all those places, but a lot of them had to devalue right away. Then you had a country out of, I shouldn't say nowhere, they're very wealthy, Kazakhstan, okay, who is one of the biggest oil producers in the world, devalued the currency overnight. So lots of currency, currency fluctuations, volatility caused a lot of turbulence in the market. Quick thing: when you have large undercurrents of instability or short-term instability in the markets, in the form of currency devaluations, slow economic growth, you name it, but primarily like credit-related situations, you are going to have what we had, because it washes up on our shore. The bottom line is we have to look for ourselves. Going back to the Fed, next week is coming up. Fed Wednesday. They're going to do what they'll do. Markets will crack a little bit. I'm going to show you all the levels I think the markets are going to do. And then by Friday, we, in my opinion, in my strongest opinion, we are going to end the week up. We're going to end the week up. In between, you're going to get slapped around like you won't know. So if you're not prepared, get ready with one slap to be on the floor. But if you on countdown to 10, if you don't stand up, you're done. So that's basically what's going to happen. All right, and the levels are very clear in the market, very clear. I'm telling you right now. So let's dive into the technicals. Everything that I said right now, I'm not asking you whether it makes sense or not. It's not a matter of making sense. Did everyone kind of hear it and sort of understand little bits and pieces of it? Yes or no?
Yes.
And at this juncture, I'm going to open up for like literally 3 minutes and ask anyone have a quick question regarding the economic global, game theory games that are being played on the front on what's going on here. Quick question. I'll give you a quick answer. Then we'll move on directly into the technicals. Then we'll talk about individual stocks. No questions? Okay. Let's dive into the technicals here. This is your life in front of you. Remember there used to be that commercial on TV? This is your brain on drugs, if anyone remembered that, right? They showed like 2 eggs frying, poached eggs, like IHOP. Well, this is the market. And it is not on drugs. It is on a very structured volatility program that keeps on hitting and just doing what it's doing. So when you look at this pattern here, you have a triangle pattern, call it diagonal, whatever it is. You have a couple of things going on here. So let's understand it so that every single time that I'm showing these charts, you have a better understanding on what's going on. So you have the bottom here, right there. No need to remind anyone. The crash. The probability of this happening immediately in the month of September, in my opinion, is 10%. So there is a 1 in 10 chance that we're going to revisit that low immediately, 1,000-point drop. It can move up to maybe a 20% probability, but I'm going to leave it at 10%. A drop down here to 16,000, which is we closed at 16,426 or 16,430, whatever it is, right there on Friday. So a drop to this level here, so this would be a drop here is 10%. A drop down 400 points here is a 20% probability. So that leaves us, so that's 20%, okay? That leaves us with 70% to play with. So 70%, what happens? There is a 50% probability. 50. There's a 50% probability, ladies and gentlemen, that we are going to hit this level here, these two levels, somewhere between 16,500 to 16,600. That's a 50% probability. Acceleration band, Bollinger Band. Just look at this chart like you know nothing about technical analysis. Just look at the patterns. So this is what the chances are. There is a Then you have this level here. Oh, the 50% probability, I'm sorry, goes both ways. There's a 50% probability that we hit 16,200 right there, or this Bollinger here, this green line, everyone can see that's a little less than 16,200. So there's a 50% probability that we are going to basically go up roughly about 100 points or go down about 100 points. That leaves us with a 20% number to play with. The 20% number is that we basically get up and break out of here. There's a 20% probability. So 20% probability is that we hit about 16,700. So that's 270 points from here. And within that 20% probability, there's a chance that we break out. We break out of this very, very defined channel. This is a very defined channel. The channel is 16,000, 16,700. I've talked about this. That's why it's so important that all of you, look at my charts and remember some of them. Scroll down the Twitter feed, go to the website, and Nandu, just passing it on to you because you're new, is you can go to clueless8.com, the website, /charts, and all the charts are populated there at the end of each day. Do it by day, do the search, look at the charts. You're an engineer by profession. I mean, and on the technical side, believe me, you'll pick it up faster than anyone. So there is the 20% move that we actually break out of here. There is I'm kind of, beyond that, beyond this probability game. If you look at a pattern symmetry, this is a pattern being played out. This is a pattern being played out. We are in this band right now. Okay, that we get up and that we complete this pattern. People who haven't been in the market, or people who have not studied patterns, charts, they just simply want to buy a stock. They buy it because it's looking good, because it's up. The stock doesn't look good when it's up. Stock looks great when it's down. If it's a stock, if it's a powerful company, that's when you want to buy it. That's when you want to cost average down. When it's up a lot, you want to be out of there. Take your profits. Go get back into it again. So point is that this move here, for people who have not really dissected the markets as I have for years and still do it every single day, is a remote possibility. A very sharp move off, and once we break out over 16,700, see this pattern here, this waterfall decline, the first stage, then a little zigzag here to fool people, and then this massive move down. Well, that was, do I think that it's possible that it retraces the whole thing back? Absolutely. Is it possible that it does it this week? I don't think so, but who knows? I don't know. I don't think so. Is it possible that it can be done by the end of the month? Yes, it can. What you think, when you think the obvious, it's not going to happen. Just like Serena Williams, right? So that's why I posted. It's got nothing to do with Serena Williams. She's a great tennis player. So the bottom line is that there is a possibility that this type of stuff can happen. And this is pattern symmetry. You got a massive sell-off. You're in this trading band. Let me just clean this out for him here. 1 second. The famous crash, the time that we bought. And some of us did, a bunch of you guys did too. So then we are in this band here. Once it breaks out of here, I can assure you there will be, once we get to 60, let's say, for example, we get to 16,000, okay? Just passing it on to you guys. You're going to hear the same old stuff over and over again. There is so much fear in the market right now, it's not even funny. Okay, it's not even funny. So does that mean that we have to get like all super excited, like, oh yeah, let's go out there and put all the money in the market? No. What I'm simply saying is that there is a coil spring in action. What's a coil spring? A coil spring is when there are very dogmatic shorts in the market who just keep on believing that we are going into a bear market. You have very scared longs, people who buy long, which is the majority, and they don't want to just touch the market. They won't touch the market at 16,007, and they'll certainly not touch the market at 16,000. I can guarantee you that. So massive media, you turn on the TV, they'll be like, okay, that's it, we're going back down here, all that stuff. Market makes a big move, just the way it did here, and on that push, if it breaks out here, there will be so much. That's what's called a coil spring. These dogmatic shorts are going to be shot in daylight. So what's going to happen is you're going to have a massive squeeze, and the market will have a huge move, and over a couple of days, it's going to move up towards these levels. Don't know when it's going to happen. Here is the other thing that happens, just so you know that. Please understand this. Please understand it. And more important than understanding, please try to apply those principles. The hardest thing to do in a market which is a breakaway market is to buy. Because what's the first little stupid little voice in the head that comes up? Oh my God, it's moved up too much. I missed it. It happens to all of us. Here is the thing about machine-driven markets. This is a machine-driven market, okay? In a machine-driven market, machines don't second guess themselves. They just act. They just act. So when machines are acting and you're getting a fast move in a fast market higher, you gotta buy into the move. I didn't make this up. You gotta buy into the momentum. How many times do I hear from very intelligent people here in my group as well as elsewhere? Oh yeah, I'm gonna just wait for that pullback. Well, like they say in New York, dude, you got so many frigging pullbacks. When are you gonna take advantage of it? So it's almost laughable when we talk about it, but that's exactly what happens every single day. And the reason it happens is very simple. Because we are human beings and we're thinking rationally, which is when you're scared, you run. When you're happy, you dance. I don't dance. So I don't dance, period, actually. Sorry. So the bottom line is that don't dance when you're happy. When you're happy and you're up a lot, sell. Dance when things are down at these levels. Dance when things are basically down at these levels. Dance like a maniac when you're down at these levels. What are you waiting for? Of course it's scary. Of course. Dance when you're scared, okay? Not when you're happy. How about that? That should be my new line. So this is a beautiful dance period. All right, so that's one scenario there. Other scenario has been thing that we break 16,000 on a full blast down. The first level of support comes in on the Dow at around 15,000. Let's call it 15,600, somewhere around there. Okay, 15,600. That's about 800 points from here. Don't freak out. Don't freak out, please. Okay, because that is a major support level, and it's very possible that if we get there, we're going to see a nice fat bounce, and that's also another symmetry. The fat bounce doesn't have to get there. The fat bounce can get up just the way it did here. The dancing algos. All right, the first bounce is going to be 16,000, and then whatever the case may be. These are patterns, pattern symmetry, pattern recognition, whatever you call it. Pattern madness. The chances of having a flash crash down to 15,400, I think, are very, very low at this point. Now, let me get into something which I've talked about a lot, but you guys should be reminded. A couple of things that I read over the weekend, very, very important. There seems to be some stability coming into the currency markets. Currencies which got blasted over the past month or so, have now started to appreciate, including the Chinese yuan and also including the emerging market currencies. What is it telling you? It's telling you that they are starting to take their risk. They are starting to come out of the cave and risk on. Risk on, by the way, just so you all know, please, and you should, I mean, you do probably know by now. Risk on means buy stocks, buy the market. Risk off means sell the market, go hide in US government treasury bonds. Is everyone clear about that? When I say risk on, risk off, I didn't make this term up. That's the term, that's the technical term. So risk on means not run from stocks. Risk on means buy risk assets. Risk assets are equities. Is everyone clear about that?
Yeah.
Yep.
I want to be very clear about this, okay, guys? If you don't understand the terms, you're finished in this market, I'm telling you, or any market. Risk on means, in trader parlance, in trader terms, means that, or Wall Street lingo, the risk on means buy risk assets. Risk assets are equities, corporate bonds, stuff like that. Risk off means get the hell out of Dodge, sell, go hide in treasuries and stuff which pay you zero, and just sit there in cash. That's risk off. So right now, from what from my reading stuff and what I noticed last week, that there is a risk on feeling in the global arena, because they're starting to feel a little bit, they're starting to feel frisky. That means we have a opportunity to make some money. Simple thing here, and I'm going to show internals in a second. This is the way the market closed on an hourly basis. One sec, sorry. That's one of my cats. He loves to just step on my trading desk, and I don't know if any of you noticed that, but on the Periscope broadcast, I believe it was 2 days ago, he decided to walk right in front of it. So if you haven't noticed it, that means you haven't watched it. But I was explaining the end of the day SPY thing, and I know that's what happens. Okay. All right. So here is the bottom line here. This is a constructive pattern in play at this point, and if you just look at it at face value, it is telling us with a contracting triangle that at this point we have 2 points that we can go up to, 16,600 and the upper Bollinger. Looking at this chart, you don't need to be a rocket scientist. You can just see that it wants to go higher. Does it not mean that we're going to open down here on Monday morning, tomorrow morning? It sure can. We got a slew of China data. They were mostly weak, but Chinese consumption was higher. So here is something I want to teach you guys about trading and Wall Street. We don't know at any given time, and that's where the game theory comes in, as to figure out where they will put more weighting. Are they going to put more weighting? The big money that runs the Goldman boys and the big money that runs the markets, are they going to put more weighting on the fact that Chinese consumption was actually higher? Or are they going to put more weighting on the same old fact that, hey, Chinese industrial production was slightly lower? Is it any news? Ask yourself this question. Is it any news that Chinese industrial production was lower? That's been talked about so much and seen so much, it's not even funny. We already know that. The Chinese premier, as I said, was on his knees telling the world, don't worry, we're going to take care of it. We're going to start a $60 billion infrastructure program, fixing bridges, all that stuff. Okay? Hopefully not building more housing, no more of the ghost cities. So bottom line is, we all know that. It's behavioral game theory. So Chinese consumption went up. Wow, that's interesting. Well, of course they're not gonna go, they want to improve their lives. So it went up. So that's a good thing. So we don't know where Wall Street's going to put the weighting on. So when at the open, what happens to the market means nothing. We could be down 100 points right at the open. Right at the open. And then we move from there. That's where technical comes in. So I'm going to be watching this triangle on a very solid foot. I mean, on a minute-by-minute basis. Just one of my many charts that I follow. This is the Dow Jones, which So here you have something that I want everyone to notice. I want to talk about the first day of did these sessions, started these sessions. Take a look at this 50 and 34-day moving average. We have had intense volatility, intense, right? First thing you have to notice is the breakdown right there, where you have the 34, the orange line completely break down below the, and this didn't happen, by the way, till we were already down about 400 points. It happened here that's when the market was, right? So that's when the market was down about 400 points. Where is this? Yeah, 17,000, around 17,000. So around 17,000, these slightly downward sloping moving averages, very critical. Want to make real money? Want to make any money in the market? Follow these lines, among other things that I've taught consistently. So I don't need to teach. That's just the way the markets work. So you have a complete breakdown. So once it broke down, it's see you later. Yeah, you had little up days and this and that, but look what happened. We crashed. We burned. We didn't burn. The market did. In fact, that was one of the best strong weeks. So anyway, and then the band. So in between, what happened? In between, the 50 and the 34-day moving average stabilized. Stabilized. The yellow one is a 5-day moving average. That's the one that gives you a heart palpitations, because the 5-day moving average is basically the fast-moving trader's line. Okay, so if you want to trade short term, follow the 5-day moving average. So that's what's in there. So the 50 and the 34, through all this massive fear, which is permeating through like a dark cloud, can't wake up every morning like with a smile. It's just like, whoa, you know, that's it. You can't even wake up with a smile if you're short, because the market opens up 300 points. So, but I do this for a living, I know. So the bottom line is that you have the 50 and the 34-day moving average is stabilizing. Look how nicely they're just kind of drifting along, while the rest of the investing and trader public are just, you know, just terrified. So at one point, they're going to cross up. This line, they're going to cross up. And that's when this is going to happen. Who knows? Maybe in October. Maybe by the end of the year. I don't know. But I'm just telling you, please focus. Please focus. There. You're starting to see little bits of sunlight. Well, guess what? There was a lot of sunlight here too when these things, you know, this crossed over. This actually crossed the 50, crossed below the 34. We had a massive rally. This did nothing. These ones were still kind of like, you know, wide. See that wide? The width? Sorry, the spread between the 50 and the 34. Well, right now there is no spread. The 50 and the 34, let me zoom in, are starting to curl up. Here's a little disclaimer. They can easily curl down, but I'm telling you what's happening in front of us over a period of weeks, not a period of days, not a period of, you know. So look at this. So if this starts to curl up just even a little bit, you are going to see a blast on the market where we're going to, you know, those are the 200-point days, just a little bit. Like even if it goes like this, market's going to be up here. Everyone's going to start feeling real good. And of course, if they really turn, this is what I call a turn. Just look at the, you know, the curvature of this thing. If they really turn, then you're going to start to see, then you're going to basically get up to those higher levels, which are bound. This is known as a range. Don't think, just look. The range is already there. Acceleration band 16,600, lower acceleration band 16,120. Just look at the range. We're in a tight range right now. Very tight range. Upper end of the range 16,520. So if we open up 100 points on the market on Monday, and you are a trader, you want to make, you know, I'm long a few things, the Amazons and that type of stuff, all played out, bunch of swings in play, all there on the Twitter feed. Don't ask me, go read that. Okay? Then I'm going to sell a good bunch of them, put some trailing stops on the others, and sit back. If we break down here, On Monday, I will buy. Now, this is, keep in mind that, of course, I'm not just doing that just because it happened there. I'm also keeping an eye on what's happening outside. If something really terrible happens on the global macro credit front, then I'm not going to be buying here. I'll be shorting here. But generally speaking, the higher probability trade is that if it's just a volatility move and the market's open down here, it's a buying opportunity. And if it opens up here or here, then obviously it's a sell opportunity. You want to capture your profits or a good portion of it. Why? Because it's money. And two, it gives you confidence to go in the next trade, the same trade again, whatever the case may be. Now look at this pattern here. So even if it pulls back here, I'm going to show you something. And please focus. Everyone remember this? And if you don't, please take a look at it because you have to remember it. What is this? Market structures. Market structures. Nandu, are you still with us? Stork, you still with us? Okay, good. He just typed in. Good. I just want you to hear all this. It's very, very important. So here we are. If you want to look at a shorter term thing, 1 second, there, and compare it with this. One second. Sorry, I'm trying to set this up. Starting the next sessions, I'm going to do multi-screens. So I don't have to move everything on one screen. I'm going to do multi-screen. We're going to look on this side of my computer. There are 3 screens, a big reader. So we're going to be covering over 3 screens. Just letting everyone know. Just bear with me as I fix this up on the other side. Okay, I think I have it. 1 second. So these are the patterns that are being played out in the market right now. Most importantly, this. These are the volatility patterns, these two. Anybody who can master them, nobody can master them. Because volatility in the essence, by nature, is unquantifiable. But you can manage them. You cannot master them. People who say, "Oh, I remember interviewing this kid once, to hire as an intern." He goes, "No, I really mastered my emotion." So I said, "Welcome to Wall Street." That's bullshit. Nobody masters their emotions. People manage their emotions, and that's as close as you'll get. So nobody masters volatility. People manage volatility. What do you mean you mastered? That means you mastered like a life, like, wow, I mastered my emotions. Okay, that's great. Anyway, I don't want to get into that. So don't fool yourself by thinking, oh, I'm a master of my emotions. You're not. Just ask your spouses. No, I'm just kidding. So bottom line is that this is the 2 patterns that's been played right now. Okay, over and over again. This is the length that I'm talking about that might happen when we get to 17,600. In between, we're going to keep on doing this. Now, this could be another zigzag. Whichever the case, the market structure low. What was the recent market structure low on the market? What day was it?
August 24th.
Okay, next answer, please. I'm going to ask. No, Jackie, your turn is up. You answer the question. It's recorded. Mark Bader, what was the market structure low in the market? Anybody who doesn't know this cannot leave this session saying, oh, I don't know. What was the market structure low? I'm asking a question here, please.
September 10th.
September 10th. Okay, 1 second here. That's an interesting one. All right. 1 second. Who was that, please?
KJS.
Hey, KJS, how are you?
Good, how are you?
I'm good, sir. How's your son's tennis?
It was good.
How old
Right
is
now
he?
he's 7.
Yeah,
Right now I'm at his swimming lessons.
awesome, man. That guy, I still miss that with my kid. Now we go to high performance, car meets. I mean, geez, how times changed.
Oh,
Okay,
that must be fun.
believe me, it is. You know. Okay, so you said September 10th. Gone tomorrow. Please answer. What was the market structure low? What was the
Well,
recent
two, I'm
market structure low? Huh?
the fourth looks like one of the dramatic ones.
I didn't ask you one of them. I said what was the
So
ultimate
the fourth.
market structure low? Huh?
Well,
What
okay, so the ultimate one in my mind was from the first.
on what?
The first
First of what?
September.
First
The
of
one where we have that
one
little
second.
blip.
First of September. I'm getting some very interesting answers. So I'm looking at my charts on the other side. 1st of September. Okay. Um, 1 second here. Okay. I'll tell you. Okay, Guru, you just walked in.
I joined about 20 minutes after the session started.
Okay, no problem. So Guru, the question here is an important one. I'm showing this pattern here. It's known as the market structure low, if you remember from the first day, right?
Yeah.
It is a very critical pattern because it'll determine how trades are going to be put in place. So the market structure low is, what date do you think the market structure low was within the past, month or so since this whole,
September 10th. I'm just looking at the 1 hour chart and.
No, don't look at this chart in the back. Look at the overall, let me do good look at daily. Hold on. The daily looks so damn good I feel like just really going aggressively long. Start listening to my own stuff. Seriously, this is powerful. This is powerful what's going on. I'm not kidding. Of course, they're going to zigzag a little bit, but this is a powerful pattern. Okay, so so the market structure low, you were saying, so look at this chart. What is, what is the market structure low?
I would say that red candle are on the September 1st. I'm just guessing.
September 1st. Here, sure. This one?
Yeah.
Okay. I have KJS has answered. Nandu, please. Which day you think was the market structure low? September 4th, he said. Okay. Nia?
I'm looking at September 1st too.
You looking at here?
Yeah.
September 1st? Okay. I see what you guys are saying. Okay. I can see why you guys were saying September 1st. Tom? Tom?
I'm on September 1st as well. September 1st is what I see.
Okay. And Vix?
I think it's August 25th.
Nice. We're getting somewhere here. So here is the very interesting part here. The first gut instinct answer is what Jackie said. Okay, and that was mine too. That it was August 24th, right? But August 24th, right? Just bang. However, depending on the time frame you look at, if you look at this, now keep this in the, but just have this on somewhere on your bookmark. Go to patterns.surinotes.com and just hit pattern so you have that somewhere. So the market structure low is drawn. 1 second. So So this is the market structure thing, right? So if you look at this move here as one move, if you look at this move here as one move, then this is the market structure low. That's too obvious, right? It was too obvious, August 24th. So that's what first thing, that's what I went with. Right there. However, if you look at the correct answer is, August 25th. The correct answer is August 25th. And hey, Ratna, did you step in? VIPS, you just stepped in? Okay, he said yes. All right, just follow through. We're in there. So the August 25th is actually the day that the market structure low in effect happened on a daily basis. That's the correct answer. Other answers are all correct too, but they are on a different grading. Now, if we look at the hourly chart here, then it becomes a little bit more interesting. Then it becomes a little bit more interesting because the market structure low at that point, okay, the market structure at that point is more defined. You get it? So depending on what you're looking at, it was actually August 25th. So who gave the right answer? Who was the one who said August 25th?
VIX, I think.
VIX.
VIX. All right, VIX. VIX is not even sure when you get an answer. Okay, so VIX also, I got to give VIX something, man. You said 1940 the other day. So he gets double kudos on calling some real technical shots there. The other day when yeah, seriously, right? That's really good. That's really good. And we held 1940. So he's obviously looking at the charts and applying a bunch of things and using his own intuition, which is very important in doing that. So that's really good stuff. So all right. So now that we've determined that this is a market structure pattern, that was the whole basis of this thing here, and a multiple. It's also a you can also call it a dragon bullish. This was a dragon bullish pattern. This is what's going on right now, in my opinion. We are seeing multiple inverse head and shoulders right there. Head here, multiple heads, shoulders. So this is a key number to watch, 16,210, which also happens to be the lower Bollinger. So right there, we need to hold that number. Otherwise, we negate that. We can also look at this as a head and shoulders. Why not? We've seen some head and shoulders play out repeatedly. The head and shoulders being, this is the head. You got a left shoulder and a right shoulder, which I showed that, like I said, the fast move towards 16,500 to 16,600. And what we do with it could show up as a head and shoulders. It also shows up as an inverse head and shoulders. So what's the trick? There is none. But the best we can do with this is this. We look at the internals. So let's get straight to the bottoms here. The internals are definitively, I should never say that, definitively, at least for now, showing higher. This is what keeps you in the trade. People who work with me know that very well, what I'm talking about. Unless we curl down, again, we are going to basically move up. That is telling you that the escaping mouth of this stochastics, okay, just like that. See that? Like a cobra. I'm getting very graphic here. Is basically telling you that it wants to get overbought. I keep on talking about this all the time. Once we get overbought, we decide. Where does somebody think it gets overbought? Very simple. Right at the top of the channel. Right at the top of the channel. So we got roughly about 230 points. So here is how it works. If we rally hard into the Fed meeting, sell a good portion of stuff. Because right after the Fed, there's a three-part move, right? Huge volatility, 200-point swings. Generally, the first move right after the Fed, whether it's up or down is going to be the third move. The first wave is the third wave. We have seen that repeatedly. And sharp. We're going to talk about actual trade strategy towards the end of this session. And Nandu wanted to know a little bit more, and certainly would like to share that a little bit more. So bottom line is, the first wave is the third wave. Is it you'd have to be stuck to your screens, like you can't even move your eyes. But the waves develop from 2:30 onwards till 4. And if we end up big on that particular day, then chances are the next day we're going to at least pull back a bit before we move forward into Friday, which I like to remind everyone is the monthly options expiration. General monthly options expiration bias is higher for technical reasons. Guys who are serious option traders to the point where they understand all the mechanics of it. I know some of you do. You will know what the basis is for that monthly bias. So it, of course, a monthly directional move, but it also depends on, where most of the expiries are sitting on. Given the fact, and I'm a simple guy when it comes to options, okay? Some of you guys, Ratna and stuff, you guys are really good with understanding a lot of the decay and everything. Let me just put it this way. The general bias is negative. Institutional bias is negative. I follow the ISEE sentiment index, which shows call put ratio, not put call ratio. It is still in the 70 to 80 range. That means there are 7 calls being bought for every 10 puts. That's clearly telling me on the commercial front, institutional front, they are still biased short. Algos and high frequency trading, they love shooting down commercial and institutional trading positions because that's where the meat is. I want everyone to understand this. If you have 10 million contracts on the expiry on, let's say, the SPY, on the SPX, let's say 1940, we closed at 1960 on Friday, all right? These algos and HFT will do whatever it takes to demolish that position. Happened to us the other day, or at least happened to me a bit other day, intraday, when I was trying to short the market. And not necessarily giving too much credence to this. I was looking at the price front. This is important, guys. This is very important. This is positive. So depending on the bias, and I'll be tracking that ISEE call put ratio, the sentiment index, very closely. It comes to my mailbox at 10 past 4. It's free. Just go into CBOE, and I'll give you the link, and put it in your thing, and you can see that. Here is something big going on, and this we talked about quite a bit. So I'd like to remind everyone, we talk about things, we learn about things, let's time to apply these things. It doesn't matter how hard it is, let's try to apply it. And I'm talking to myself too. Okay, let's apply pure technical discipline. The last session that I did, I talked about with, these were individual sessions with a couple of, it was on the weekday. I talked about the fact that, you know what, we could get a repeat of October 2015. Let's not forget what happened in October 2015. All right, from here, that was October 2015, right down here. Okay. And if we were robotic, and we did do very well on this side too, there's a lot more volatility this time, no question about it. Which way this gets resolved, we don't know yet. Okay. I'll tell you which way it's going to get resolved. It's going to get resolved higher. And I can give you technical justification for now why it's going to get higher. For a short term, for a short while. So bottom line is that was October. So I was saying that if we follow the technicals on the stochastic side, for example, which was clearly saying, despite nice consolidation days and stuff last October, this was a 1,200, 2,000 point move. Huge money. Did I buy down here and hold all the way up there? Repeat again, I've said this before. Absolutely not. I staggered my way up, and it was great. A $10,000 straight out, I've said this a few times, I'll say it again, a $10,000 S&P investment here would net you about $200,000 up here. So question is it a direct repeat of that? No. Is it a kind of a similar type of pattern internally? Yes. Are we going to get a 2,000 point rally? I don't think so. Right away. Is it possible that we come and retest the downward sloping 34 and 50 at 17,000? Another 600 point rally? Yes. I do believe it's going to happen. 17,000 countdown. I'm not just making these things up. Look at that. The 34 is at 16,976. The downward sloping 50-day moving average on the daily is 17,247, guys. The upper Bollinger sloping down hard is 17,617. That's 1,200 points from here. Is it possible that we get up to 17,600 and crash and burn? Absolutely. Biggest rallies happen within the context of mini bear markets. I don't know if we're in a bear market. It certainly looks like, when you look at this particular picture, it's a mini bear market. Let's call it a tactical bear market. So in that case, you got to reset. You got to reset before you fall again. That's the process we're in right now. I'm not asking for new highs in the market. I don't want new highs in the market, because you know what? You know what new highs in the markets do? It makes you miss so many trades you feel like hitting yourself with a bat. Because every morning when you wake up, something's gap opening 30 points. I hate it, because you might have a little bit, so you're very happy. But how many times have we had gap opens when we have not been fully invested in that trade? Way too many times. I'm tired of it. So we don't want new highs in the market. We don't want like crazy amounts of huge speculation. We want limited speculation. So saying all that, I'd be very happy to see a move up here and then a sharp pullback down here. Is it possible that'll happen off this level? Yes. Is it a higher probability it's going to happen over the 34 and the 50? I say yes. I think we fail at the 34 and the 50 on the first attempt big time. And it's going to happen, in my opinion, in October. Remember, October has the most violent downsides, and then ends the month positive. Just remember that. October is a month that ends positive. October 1987. Still remember, starting college and all that stuff, right? And no idea what's happening in the real world. October 1987, market crashed 25%. Within a matter of days, it started running, and October ended in the green. Same thing happened with October of 2014. Let's not go back to dinosaur age of 1987. Let's look at 2014, last year. Last year, right there. October crashed, middle of the month. So that's why I'm saying we're going into this tricky phase here. On October, middle of the month, I can write it down. You're going to see massive blast, give or take a couple of days, down. And then you're going to see a monstrous move up as we get towards the November period, and you better be in it. So this is positive. Now, let's take a look at something that I just showed, which is a vortex indicator. It's a trend indicator. It makes a lot of money if you follow it. Now, I just want to stress one thing here, key. Following technical discipline is not for everyone. People need to train for it. Okay? It's like serious muscle building. So technical discipline doesn't just come naturally and says, oh, I really want to be, please embrace me because technically this is what's going on. Because it's the hardest thing mentally to do. But if you follow technical discipline, as I was going on with the October thing, and I mentioned this in one of my single sessions with a member, that you would have made a ton of money. So I'm actually applying and being much more robotic myself on technical discipline now than I've ever been in a long time. It's not making my life easier. It's certainly making me more money with smaller trade sizes, because there is that level of uncertainty. So, you could be whacked down. It happens. So saying all that, look at what's happening to the vortex indicator. I don't need to explain to everybody, okay? Let me just point out one thing I do know from past experience and from this thing here, that if once we have this, please mark this on your charts. Let me stop myself for a second here, because this is something which is critical. If you guys are not using somewhat one of your platforms just for charting, mind you, your trading platform, I don't care what you use. So the thing is, on your charting platform, if you're not using some of the ones that I use, which is TradingView, freestockcharts.com, the keyword is free, and you will never see these things the way I see it. Please don't come to me or come to yourself crying because you didn't see these on some other charting platform that you're using. Because if you don't have the visual guide, you are finished. I'm telling you right now. You're driving in treacherous terrain, yet there's a beautiful landscape waiting there for you to arrive, all right? It's like driving in Vermont, all the way up in the mountains, okay? Seriously, or up in Maine. I don't know if you guys have been there. And you get off the roads, get your Land Rover, your Range Rover, your Jeeps, and you get up there. You know what? It's gorgeous, but to get there, it's tricky. So my point is very simple here. You gotta use one of the platforms I'm using. It's free, use it. Because aside from that, you will not get these charts, period. I can't even stress that. Makes me cry when people say, oh, I'm using Scottrade here, and I don't see that. I have no comment. I will not respond to those comments. So saying all that, the minute you have a, this red line comes down here, and this blue line here, okay, which is the vortex or the green, whatever, vortex up is, look how nicely it's moving up. This is telling you there's accumulation going on, that the primary trend, short-term, intermediate trend is up, despite the volatility. Once you have a crossover right there, this is point of maximum inflection, right there. And given the fact that the range is so wide, guys, ladies and gentlemen, when you see this, let me zoom in more. What happened? 1 second. I'm trying to get the pen. Can't have it? Okay. Can everyone see the screen?
Yes, indeed.
Can everyone see the screen? Yes?
Yes.
Okay. So for some reason, I lost control of the, oh, I got it. Did we get it? Trying to get the, GoToMeeting won't let me have the control of the pen. Okay. So I'm just going to just show you by arrow. Sorry about that. So when you have that crossover here, you're going to get maximum overbought on this, getting up here, and this will cross at the point of maximum crossover. And it's not that it always crosses over. It can do this, where it can just kiss and run. Okay? But this red line coming down, crossing, the negative crossover on the vortex is actually a very positive event, or a positive crossover, because the green line's moving up. I believe that happens right at the battleground here at 16,700, right around there. Big battleground. At that point, if we blast up, we're going to move up so fast to into the 17,000s. You better be ready for it. There is no chance at this point, given the massive overbought condition on the vortex here, on the daily, mind you. This is the daily, so you have to have patience. That it keeps on getting more overbought, because the most overbought that we got into on the day that we had the flash crash, the vortex was down here. Hold on 1 second. So the vortex was down here on the day that we got we crashed and burned, right? And then it turned. So right now it is coming to approach, it's basically coming at that inflection point. We have an inflection point coming up this week, mixes in exactly with what the Fed's going to do and all that stuff. But at least if we see a crossover where this green line shoots over this, and I don't know why Thinkorswim is not giving me the pen, charge of the pen that I need. Okay, it gave me. Great. I'm a genius. So when you have this here, this crosses over, bang. you're going to start selling right away, not buying. You can buy a little bit into the acceleration phase, but by that time, there's going to be such a big move up, and possibly we test. We get towards 17,000. At around 17,000, you don't want to be a hero. You want to unload a good portion of your trading longs because there's going to be selling there. Okay. And of course, the selling will bring us down to the probably lose another 300 points. And from that point, the market maybe completes this pattern here, which I think gets done 17,600. What the time frame is, I cannot tell you yet. Could be the end of October, could be earlier. I don't know yet, because that's a good solid 1,200 points from here. I'm sorry, 1,000 points from here, 1,100 points. So I just want to be very clear about that. So that's your picture here. There's a lot of other things that you can put on there. People use a lot of fancy indicators. I'm just showing you some basic stuff, which works for me. You can look at the Coppock. It's big stuff going on. Now, if you want to know who Mr. Coppock is, please go to Investopedia and find out who he was. But the Coppock curve has been an extremely reliable directional trend indicator for a long time. So this one is telling you that despite this very contracting, triangle right there, right? That this is where Mr. Coppock for now wants to go. He wants to go higher. He wants to get to zero. He wants to do what's known as mean reversion. The standard deviation from the 50 and the 34, when things just fell apart, thanks to the massive hedge fund dumping and stuff that I've talked about extensively, and the panic that ensued here and in global markets, was almost 4.5 standard deviations. That's unheard of. So even if you knew nothing, you said, you know what, I'm going to buy a little bit here. I'm just going to sit tight because the market's got to bounce. And guess what? You're probably going to be right. So the point is, I don't want to go into it too much, but the Coppock is also confirming that on a daily trend, we are going higher. Now, let's look at an hourly. And I'm focusing on the Dow because, it's kind of nice to look at these things, from a broader perspective, because that is the psychological indicator, the Dow Jones, right? Not a tech, not for technicians and stuff, but to overall. So this one is also now it's starting to do the little funky stuff. It won't let me do that. Okay, so if you look at it here, it's also pretty good. So the overall outcome for September, in my opinion, is going to be up. I think the overall outcome for end of the week is going to be up, but we are going to see some severe volatility. And of course, the markets love to, for technical reasons, for market making reasons, they like to pull things down before they move things forward. So that is the market outlook for now. Bear with me 1 second. Just give me 15 seconds to just go ahead and TradingView, best charting system you can use for your eyes and for your wallet. Honestly, it's free. Isn't that great? Okay, not trading system, charting system. Very clear here. So this is what I'm looking at. Can't be any more clear on the SPYs. 199 is the top, and all this is, we're going to get overbought really quickly for the Fed. Look at this. This is a daily chart. This is actually more clear. We're almost reaching the inflection point. Inflection point doesn't mean that all of a sudden the negative vortex is going to cross down. It simply means we're going to kiss it. It might, it might just do that and then start to move up again, fool people, but I'll be watching this very carefully. So what I'm getting at is there are very clear in technical indicators telling us what's going on. Look at this, stochastics. That's what kept me in the game. That's why buying Amazon gave $10 for the day almost. Almost $6 for the day from the point of entry. There's tons of them. SPX, same story. You have to be stock selective too. So that is my read on the markets as I see it. Intraday trading is a different ball game. So that's something that, that's something you'll have to handle yourself. Isn't stochastics already overbought? No. Where do you see that, VIPS? And next time, by the way, you need to have a microphone. The stochastics are not already overbought. They're getting overbought on this front. But if you look at other charts, for example, I mean, if you look at an hourly, even on the hourly, it's not fully overbought. No. And then we have the crossover. What do you think? We're up 100 points on Friday. You made money on my call. Look at this. You want to mess around with a crossover of the VI? Sure, you can on a short-term thing here, but this trend is saying that the market wants, just short-term, I'm talking 48 hours, wants to move higher. This is certainly not. I don't see overbought conditions here. I see overbought conditions once we reach around 198, and it's very clear here. So in answer to your question, no. If you want to look at it as you get closer and closer, then you start to see things. This is 30 minutes. Yes, that's getting overbought. It hasn't turned yet, but it's overbought. We'll look at 15 minutes. Still pointing up. I mean, I'd like to see, the overbought territory, no question about it. Look at this. 5 minutes. Still not turning down. Overbought, yes. Look at this rejection. The green was supposed to, this is what it fooled in things, right? This was 7:45 on 9/11 before the market opened, right there. This red bar. Oh, it's going to be really bad. And guess what? It was very tricky, right? I went with technicals as well as what I understand. I remember myself. It's a very emotional day. It was a day that my son probably wouldn't have, seen me here today doing this, okay? Because I almost got fried. No pun intended. So the bottom line is, you don't mess around, please. And usually that's not a technical indicator that not on September 11 the markets are going to be higher, but just, look what they did. So anyway, now I'm going to go ahead with answering a couple of quick questions. What time is it? It's what time? Oh yeah, it's we have time. So feel free to go ahead with questions and things that I can look at for all of you guys. Feel free to use the microphone or type in a question or two. Oh, let me talk about the trade management part, okay? And this is a question from Stork, Nandu. Nandu, let me just put it this way here. Trade management is something that you will really have to learn on your own. Given the volatility and everything that I've explained on an intraday basis, there is no way possible I can tell you what to do. However, if you're entering positions based on the overall bias of what I showed you, given the fact that you understand that you actually bought into my idea that, okay, technically looks like the market has another 100 to 150 points to go, then you obviously want to swing trade your trades long. What happens during the day, as long as the internals are justifying a move up, should not affect your mentality. Just because you bought something at 5, give you an example. Let's say you bought an option at 5, whichever the case may be, whether it be S&P 500, Amazon, whatever, and it's down to 3, but all technicals are justifying that it's going to be higher by the end of the week or at least before the Fed. You should be lowering your cost average at that point and looking to sell into the spike that comes either before the Fed or after the Fed. So the interim fluctuations that happen intraday, if the technical backdrop is showing you that we are going to end higher, should not affect your portfolio. Even though you might be down some money in the short term, but you need to use that to your benefit. That's the reason you got to track your charts. I cannot help it if people can't look at my work during the day and stuff, but it's not that hard. They can quickly go ahead and take a look at it and make a determination whether they want to stick with the trade or not stick with the trade, period. All right. If something dramatic happens, I'm going to say the trend has changed. Number one. Number two, play with smaller sizes. Don't go out there and buy 20 contracts. Buy one, buy two, buy three. So that you have enough cash to buy more on a quick technical intraday pullback like Friday, and then end the day up looking solid, and then deciding whether you want to take some money off the table or not. So trade smaller. If you remember one thing about this business, paper trading is garbage. It teaches you nothing other than, oh, it's this is the way things work. Fine. When you get back into the battlefield, emotions take into place. Trading is 99% mental. In this volatile markets, I would say it's 99.9% mental, because the volatility algos and high frequency trading programs want you out of the trade, whether you're long or short. So how do you develop your mental muscle? And Nandu, for you, this is directly to you because you're new. You develop your trading muscle by taking very small positions and being in there. Like that saying, okay, I live by. The pain of sacrifice is far less than the pain of regret. What it means in English is that if you do something and fail, you learn something from it. If you don't do it, and whether you failed or won, you learned nothing from it. Just remember that. Okay, questions. How do you scale in terms of percentage of buying or selling? Is it 50, 30, buying or selling? Is it, I'm getting all confused. 50, 30, 20, 30, 50. Oh, as in a scale. Yes, good question. So the scaling wise, I always start off with small. So it'll be the backwards. It'll be 20, 30, 50. And at the point of acceleration, I'll add a little bit more, but that is close to my exit position too. It all depends on the level. I always start off low. Pull back, I'll add the same amount. As it's accelerating forward, that's when I'll add the other 30% or so. And so again, stage one, first entry, small. If it's an accelerating stock, not everything moves the same way. If it's a Tesla or a Netflix, it's going to be, it's running. Within the first half an hour, I'm up 8 points. I'll go ahead and put 40% of that position right there at play immediately. And then get out of it, because those things move fast. And how many times have we done this? $2 up to 6. I want to maximize my position. I'm not going to put 100% of my allotment at that go, but I'll certainly use a bigger allotment. If it's a standard movement where it's a swing trade, I'll start off on the 20% level, meaning buying 20% of the position, buying another 20% on a short-term pullback intraday. There is no discipline there's no like discipline you got to follow, which tells you like exactly the same rule works over and over again. And that's the reason why it's so important that I made everyone read that piece from Dr. Steenberger. Okay, and I'd like to share that again for everyone to literally print out and keep on their thing. So I'm going to put this in again. I don't want to be like professorial on this matter. Okay. So look at what it's saying here. Forget saying here. This is the way I live my life. Okay. Sticking to a process, controlling emotions, and staying disciplined. Well, I use that term to staying disciplined, but I stay disciplined in the sense that I am always ready to adapt. So please, those are my standard rules, but I am not a dogmatic rule maker or a rule trader. Okay, I will adapt to the positions, but that's generally what I do. Great. Want to get an idea if you scale in small or big? I always scale in small. Thanks for asking. Yep, absolutely. I do scale. Yeah, go ahead.
I have a question. You say you add on pullback, right? So exactly what do you see and for confirmation and add?
Okay.
Is that stochastic turn? Or?
Yes, I look at the whole things that I keep on showing you guys. So if I see a direct answer to your question, very good question too, is if I'm looking to play that on a short-term basis, I'm looking at the 1 hour oversold positions. I'm looking at 1 hour stochastics. I'm looking at 4 hour stochastics if I'm looking to hold it longer. Okay. And I keep on adapting between 30 minutes, 1 hour, if I'm looking to trade that intraday. That's what I'm looking at on a pullback buy. So the stochastics, when they get, on the 1 hour, if they get, and of course this is what makes it very difficult these days. That was Vix who asked the question.
Guru.
Oh, Guru, yes. So Guru, what has been difficult these days is that the 1 hour stochastics, for it to get oversold, which would be which is almost 90% of the time, Guru, a short-term buying opportunity. For the on the 1 hour basis. Sometimes in order for it to do that, the algos make it happen. I mean, it takes the full day. In other words, they will just keep the market in a very tight range. So you don't know whether or not you're going to buy or not buy. And then right towards the end of the day, they'll drop it, get it oversold for a nice, for a pop-up the next morning. So what I'm getting at is that this resets don't happen in 1 hour. Sometimes they'll take 3 hours. So that's the reason it's almost like paint drying on the wall. It's happened to us. We're looking at things. We just want the market to do something. We just want the market to do something. The algos know that too, because they're seeing other traders forcing trades. So that's why patience is so critical, because just to get that 1 hour oversold basis where I feel good in really buying something fresh or adding an existing position might take 5 hours. But generally speaking, the stochastics is the best way, on the simplest way you can look at things, aside from other stuff that I keep on showing. Yes.
Okay.
Yeah. Nandu, go ahead and ask me a question. Stork? How many types of algos are there? Oh, that's a question of the day. I have no clue. There are tons of programs out there. Okay, I know how many types of algos are there. They're the good ones, the bad ones, the ugly ones, and the ones which are just killers. And believe me, I know all of them, and all of you guys go there. That's a great question. Honestly, these are all trading programs that are written, from here to China, to India, from Ukraine. A lot of algo machines are run by Virtue, which is based out in Europe. So let's put it this way: smart programmers do algos. There are lots of algos. I can write an algo, for example, with all the stuff that I do. Okay, but remember one thing here, and that's a good question. Let me answer this in this way: algos themselves don't know what to do when there is a breakdown in the way they think things will go. Okay, so that's our advantage as humans. We always talk about the fact that algos have an advantage over us. We have an advantage over them too, because we can react not quicker, but we can kind of read them out and show where they're hiding. And I tend to do that quite often. And so there is no one way to tell, because not all of them are swimming like fish all in one direction. There are algos fighting algos, right? So when you have on a certain day, you see certain hedge funds, buying certain stocks are green, and the market's up, and you're wondering, why isn't that stock up? Why isn't Netflix up on a hugely green day? Why isn't Frank buying it? Well, I don't know which stocks they're doing exactly, but the point is that there are hundreds of thousands of algos that are written. So I heard their trend following. I heard their trend following risk parity. Okay. Yes. So basically the risk parity and all that stuff, right? They're different. They're trend following algos. They're risk parity. Yes, you're correct. I thought you asked like how many different algos are out there. Those are just the big ones that we know. The trend following and risk parity, look at it in common sense. Okay. There are algos which are hedging. They're doing all kinds of different derivative hedges and moving between ETFs, the UVXYs, for example, the TNAs, the TZAs, you name it. So there's risk parity stuff going on. Trend following, hey, charts. Things are moving up, jam it a little bit more, move it up a little bit more. But here is the difference. Just because algos are in one position or another will not give you a leg up, because the minute you think the market's going up, and if you're not really going with the critical levels that I'm showing, I'm not saying I'm showing, but the ones that I'm pointing out, then you won't know. Because if you think this is a breakout, let's say, for example, the market breaks out here. let's say the market breaks out here. How many times have we seen it? And people who have been with me know that very well, that they're immediately going to slam it down here, and most probably will bring it down to the bottom of the wedge and then decide what to do. Sometimes they break it down, sometimes they'll break it up. So just by, the algos know that very well. Sorry about that. So the algos know that very well, and they will act accordingly. So not all algos are moving in a fashion. They're not like in one big nightclub in New York saying, you know, we're going to do this together. So, but those are, yeah. So the trend following ones, the risk parity ones, and you know, you can Google enough information on them. But just remember one thing: I mention algos as a proxy for what we're doing. You can't make money trying to figure out what they will do. Just wanted to let you guys know, okay? Because those machines are moving for 1/100th of a nanosecond sometimes. So I think we do pretty good by trying to read them out and instead of trying to follow them, because you'll never be able to follow them, period, because there are so many and they're doing all different things together. Okay, question: how about anything you can say about using SPX futures to anticipate SPX moves? Yes, it's 11:50. I'm going to spend the next 10 minutes on futures, okay? And this is coming from my good friend, Mr. Gone Tomorrow. Gone Tomorrow where? Just kidding. All right.
Hopefully a beach
So
somewhere.
what was that?
Hopefully a beach somewhere.
Nah, beaches are overrated. Okay, 1 second here. Just kidding. Remove all drawings. This, I want to just show this quickly. Actually, it's a beautiful chart. It really is. I mean, this chart, there's the only thing that is that I can think of what's negative is, let's put it this way. Actually, these are just regular bar charts you can do. So right here at around, it looks like we can, you know, we're going to hit some turbulence right there. But this is telling us that the first that getting another 100 points. This is a 10-minute chart. Getting another 100 points, you want to be a seller of your profits. Right there. I hope everyone can see that. Very clean chart. Okay, this is the Dow Jones. Pattern completion. And I'm going to go into the futures right now. Pattern completion, ladies and gentlemen. Getting better. There you go. Rising wedge right there. Everyone clear about that? And I would say that every time I've seen this type of patterns and I've shown it to you guys, it has come correct. Massive double bottom. We'll move on. Futures. Let's see. Let's take this. For futures, you got to use, I use Thinkorswim. All right. So let's look at the E-minis. This is the daily. This is the daily, okay? This is last October. This is now. What we are concerned with is what's going to happen next week. So let's look at the hourly. This is the hourly futures chart that you're looking at. And remember, futures are moving at light speed too. So starting in a few hours, in about 6 hours time, we are going to see the fireworks start, because that's when the futures start trading, right? 6 o'clock, 6 p.m. New York time. So the first thing is, if you see a move up, you're going to see the futures bump up roughly 1972, right there. Right there. Okay. For futures, I use the Darvas box. The Darvas box, and of course, I look at the moving averages, but the moving averages in futures are moving quite fast. When it comes to futures, we are overbought on the 1 hour basis. Here's something I want to remind everyone. Futures operate 24/7, right? At 6 o'clock, we can start to see how it's doing here. So once it gets overbought, it will get oversold before the market even opens. I'm saying if it wants to, it will get oversold before the market even opens. Now, how do I use futures to my benefit? I look at them in the sense of the same patterns, but more importantly, I look at them in the form of the stochastics. When stochastics are severely overbought, okay, I'm not going to rush in there and keep on buying, even though it can stay overbought. Just because futures are up here doesn't mean they have to come down and reset right away. Futures are up here right now, 99, right? So that's overbought conditions. When the market opens, let's say futures open down 20 points. Let's say futures open down 20 points here. Let's say the futures open down to the lower. Look at this Darvas. My God, this is a bottleneck. See this? This is a major bottleneck. So let's say the futures open down and test the lows of Friday, right there, 1930. So we lose 22 points for reasons I mentioned before. The China news can be interpreted as somewhat negative. It means nothing for the next day, because by the time it pulls back, this particular stochastic will get oversold again. So you cannot really trade completely off the futures unless you're a futures trader, but it gives you a proxy on what's going on. So let's look at look at what they were doing, since I also look at futures volume in a big way. So look what they were doing. They sold the market right at the open on Friday, and then all through the day, all they did was keep on buying. Then came 1 o'clock, little selling. Look at these candles. So there was a lot of buying that happened on Friday. So the futures give you a nice indication of what is happening underneath the surface. I do warn you that because they move faster, they are a little bit harder to read, and over time you'll be able to read it. So looking at this pattern here, there's really nothing that negative about it. Even though short term, like I said, it's a little bit overbought, and but overbought is over 80. So on the daily, if you're looking at the daily, looking to figure out, like I explained to you guys very clearly, on the daily, this is the danger point when it gets above 90 and 100. Okay, just want to be very clear. So these big swings in the market, which happened over a matter of days, forget about weeks, you can simply follow and see what's going on here. So unless we get severely overbought, which I think we do when we hit the 2000 level on the futures. Look at, here's the back testing the 34-day moving average. That would be a good shorting opportunity in my opinion. Okay, anticipating S&P moves, that's a broader picture. On a shorter term basis, I don't like I said, I look at the oversold, overbought conditions, whether 30 minutes. And on a stock, I use it all the time. So, so here I'm looking at the 30-minute. On the 30-minute, you can see here again, we closed on a very strong note, so that's the reason why it's overbought. And on the 15-minute, up there, so there's a very strong finish as we saw. On the weekly, let's give you a picture on what you think, what can happen on the weekly. You have to mix in. There's so many moving pieces, but you have to know there's no rule that it follows, so you have to kind of use a lot of intuition. It's art, like I said, it's more like art appreciation. So look at this here on the futures. Look at this. The weekly. The weekly is telling you that it wants to go higher. Look at this chart here. 1 second. These took me years to fully, for the charts to talk to me. So it'll take you guys some time. So like, for example, the 5-week moving average, that's in there. It hit that, it pulled back here. Where, the bottom end is that we could go to 1900, which is the lower end of the Darvas. So the upper end of the Darvas is around 2100. This is on a weekly basis. Weekly, the futures are indicating that they want to go higher, but these lines move quite rapidly. So just, start tooling around with them. But most importantly, when I show you guys the future charts and I put a trading range out there in the morning or during the day, but mostly in the mornings, then you'll be able to track it. But they show you a lot. There will be a session where I will completely concentrate on all the other or most of the other internals that I look at and the other indicators I look at in order to make my determination. And even then, it's not an easy job. And I think everyone knows that because of volatility. Volatility skews the most obvious patterns, so you have to use a lot of your experience and your intuition to move against it or with it. And that's why the reason why you guys are with me, because hopefully I try to translate that better. I translate that better than most people out there. But the acting on it is a different story. That's something that you got to do on your own, and staying technically disciplined is the hardest thing you'll ever do in your life. So right now, that's the picture. So one more question and I'm going to wrap it up.
Just one question on the futures.
Yeah.
Is there a time advantage, is the futures ahead of the
Always,
move
always,
that you missed
always,
or something?
always. There is no time advantage because they're moving so fast, but they're always ahead of it. So yes, in answer to your question, will you be able to capitalize on it immediately? Yes, if you're a fast trader, you can. I mean, I point out a lot of the times that there are futures buying and selling coming in. I have algo charts, which I'll go over the next time with you guys. Okay, those are the bar charts. Those, every tick tells me, you know the ones I'm talking about, right? I hope you guys know the ones I'm talking about. Do you know what I'm talking about? The ones which are the pivot charts that I keep on showing?
Swing 53.
Huh?
533. Is that a swing 533 chart?
No. Listen, by now you guys have to know the difference between these charts. It's so important. This is what I'm talking about. I say algo HFT charts here. If you don't know the difference between this chart, for example, gives me literally 5 minute signals for me to trade off. And in order for you to fully utilize this chart on a very short-term basis, you'll have to subscribe to this service. Costs about $100 a month. Well, I pay much more because I have other features with it too. But for members and stuff, if you mention, then if anyone's interested, they can reach out to me. It's $100 a month. You know, this is the algos chart. Every single tick is money. This is the one that gives me the early warning thing aside from TOS, and it's just fantastic. And I just read it all day long. Constantly, it's on two of my screens. So this is known as the bar charts, okay? Bar chart is actually an independent company. But the company I use here in the New York, New Jersey area, they have a whole system that they are, which normally costs about $300 a month. Not system, I mean a quote system and chart system. So I talked to them because a bunch of people, friends, took advantage of it, and they said that they would be open to giving to people for $100 a month. So this one, for example, you can tweak around. This is hourly. You can do this on a 5-minute basis between the Bollingers and this, and this allows me to see literally within a 5 to 10 minute basis what the markets are doing, because every single bar is worth money. Now, do I know what time exactly the bars are going to move up? The quickest way to do it, one second. Quickest way to do it is I play between the Bollingers. I play in between the lines that I draw. And of course, I put pivots on there. It's not on here right now. Pivots and resistances, and they're pretty damn good to read. And I've made a lot of money for a lot of people by showing these charts and putting out the trades out there. So that's the answer to the question. But I think in lieu of that, you can simply use TradingView. TradingView is the easiest one to read. Okay? TradingView is the easiest one to read. TOS, Thinkorswim, you have to get your eyes trained how to read it. You need big screens, and you need to know how these, it took me some time. All right? But TradingView will do the job for you guys. Okay? TradingView will do the job for you guys. Where did TradingView go? Hold on. 1 second. But I'm telling you, if you're not using, that's not the one. 1 second. I'm just trying to put the, okay. So TradingView, it runs on BATS. It's free. and you can track the SPYs and the Qs and the IWMs, really well. This is my opinion. If you want to know how to trade, well, this is not the futures, right? This is your actual thing. You can get futures on TradingView too, but you have to pay much. Obviously those feeds cost money. So I would simply use this and use the futures on the Thinkorswim side to learn how to read them, but use this TradingView chart as your proxy for trading the market. I mean, I can't even tell you how clear they are. I love it. Look at this. Look at this. Now, I don't know when the next green candle is going to appear, but if I'm looking at the stochastics and stuff, I'm going to stick to my trade. Do you guys follow me on that?
Mm-hmm.
These are volatility candles. They just appear from nowhere, whether it be green or blue. What was the day I got caught in the trade? I think it was the 10th. Yeah, on the 10th, right? I was short, and this is what the market did. So it didn't matter what I thought. I mean, here. And then the next day, the market opened down. So here, the market kept on going higher, even though the stochastics, well, actually, the stochastics were pointing higher. But middle of the day, they looked like they're going to curl down, didn't do all that stuff. So use TradingView. Is 5 minutes let me see here. And by the way, today I'm charging you guys all overtime, all right? So just letting you know. You'll be billed about $50 for every 10 minutes. Okay, anything you can say about futures? How do you trade futures? I used to, and I intend to do it again. That's the answer to your question. Yes, I intend to go back to it again. But if I trade futures, I'll be sleeping all through the day, so you guys are going to miss making money without me. What can I say? I'll be shutting down my positions by the market open. That's what I used to do within the first hours, and after that, who's going to be the clueless to guide you guys? So think about that. Is 5 minutes the shortest intraday time frame you use? Yes. No, sometimes I use 3 minutes. It doesn't make a difference. 5 minutes is good. I have pro account in TradingView. What is the ticker for you in TradingView? VIX, ask TradingView. I don't know. It's there. I mean, TradingView is, you'll be able to find it. I don't know. Okay, guys. So I'm going to wrap up. I just want to make sure that I have everyone here. How many people did we have in here? Tom, Vix. I want to keep track of this here. Mark, you have any questions?
No.
Okay. I'll show you, because I know you have UVXY traders, but UVXY is just like any other ETF. It's on crack, right? So
Right.
yeah, so you can't always make charting or decisions on that. On the 1 hour, looks like it wants, it's certainly, getting there. Just it jives in with what I'm saying, that the market will get overbought before the Fed. UVX is a great trading vehicle. There's no question about it. DWTI is also, but always keep in mind that on any big moves in the market, up or down, you are going to be, unless you're really fast, they will take you out with the stops and stuff. But right now we have a pinched Bollinger. This is trending down, so I wouldn't be surprised. I would be a very enthusiastic buyer of the UVXY at around $57 or $58. Okay, I would, because by that time you would have severe oversold conditions. You would have a nice you'd have a nice what do you call it, vortex, up here. And it's funny, the vortex moves the other way on this one. It's the inverse. So I'll be looking at this to trade it. But again, at this juncture, just like the market, you have to really, charting UVXY is really not a good idea, but at the same time, why not? 1 second. There. So this is a falling wedge. I'd be a very excited buyer, the falling wedge at around 53 to 58, where you could have a nice swing trade on the upside. And by that time, the market would be overbought on the levels that I showed you guys earlier on. So that's what I'd be looking at. However, if this is a multiple head and shoulder, if this is a multiple head and shoulder, this being the head, they're showing that we have made a high for the year, okay, which I think we did. Then this is a right shoulder, and this would be your left shoulder, multiple left shoulder. You can see how it's playing out. And then you have a neckline. And the neckline is basically at 48. So is it possible that we get down to the neckline to test it and then make a move from here back towards 72? Very possible. That, I believe, happens in October. Okay, so the October move on UVXY should be something to grab on and make money over a couple of days as the market consolidates for reasons that I explained to you. But in the meantime, basically, if we break the neckline, that means the intermediate term bull trend is back in play. That means the thing is going to go to 24. Just so you know that, okay? That's only if we break over 2100 and continue our journey upwards. But in this type of environment, believe me, there's so much money slushing around with the central banks and what they want to do. I wouldn't be surprised one bit if they decide to do that. However, one thing at a time. So looking at this is a negative pattern short term, and of course it's trading within the Bollinger Band here. So 60 would be your downside. Break of 60 would be around the 50s. That means the market's surging, and in the meantime you could be trading this. So I will certainly be posting more UVXY charts for all of us to trade off here and there, and it's certainly it's pretty defined at this point. Just so you know. All right.
Right.
Okay, so let me wrap up, and it was great having you guys there. And if anybody, I'll put this up on the YouTube for you guys to link on, or just send it to the ones who listen to it. But it should be there by later on today. So whatever you missed, you can certainly review it. Fair enough?
Yep.
Okay,
Right.
and the only thing I would like, yes, go ahead. The only thing I would like is for you guys to obviously, stay involved with these sessions and encourage others to attend it, because these are invaluable for you, and it's certainly fantastic for me to interact with everyone and review this before the market starts. Because honestly, I wouldn't be sitting here on a beautiful noontime and going through this right now. All right, so I'm doing this for everyone, and of course for myself too. So thank you. All right, take care.
Thank you.
Absolutely. Great.